Thank you so much for joining. So here's the thing. So I am Brett Waters. I've been in Silicon Valley my entire life. Been CEO and founder of 3 different software companies. Today I teach entrepreneurship at Stanford University. I teach 2 courses. One is focused on getting from a startup idea to product market fit. And the other course I teach is about getting from there to scale, because they're really kind of 2 different processes, right? And I wrote a book recently called The Launch Path, which is basically about one of my Stanford. And so we are here to talk about spreadsheets for startups. And as we go along, please do me a favor and type any questions that you have into the chat box. You can start right now with anything that you want to make sure that I cover during our short period of time together today. And my goal for this session is to convince you how easy it is to create an economic model for your startup. That in my time working with literally hundreds of different startup founders, I've definitely noticed a pattern, which is a lot of new founders get stuck at this process, right? That they know that they need spreadsheets, they know they need some sort of financial model to show investors and to show others, but it can be kind of intimidating sometimes to sit down and create that. And I think for 2 reasons. The first reason is that, who knows, right? We're an early stage startup, and so trying to put numbers behind it kind of seems a little daunting just because we don't know. And the other thing is that a lot of people, when they think of financials, they think of all the accounting terms, right? All the GAAP accounting terms about depreciation tables and amortization and revenue recognition and all this other stuff. And so can seem a little intimidating. And so my goal here today is to get rid of that and get you unstuck and make you realize that you are fully capable of sitting down and doing this for your startup. So do not outsource this. Do not go and find a freelancer on Fiverr to build your economic model for you. That's another one of my big goals here today, is to convince you not to do that. Because the reality is that if you're going to be a CEO, if you're going to be a startup founder, if you're going to run this venture, you have to feel the fundamental economics of the operation in your bones, right? And the only way that's going to happen is if you sit down and build it yourself. And so, again, that's one of my goals today, is to convince you to not think that you need to find some freelancer to do this or a CPA to do this or something like that, that you are fully capable of sitting down and doing this. And in fact, if you do it yourself, you will be a whole lot better at running the company. It's always a huge red flag for me if a founder is pitching me on their startup idea, and as part of the pitch, they show me some spreadsheets, and I look at the spreadsheets and then I say to them, "This is really interesting. Thank you. Tell me how you came upon this number right here. Tell me you're thinking about this number." If their answer is, I don't know, I hired somebody to put these together, that's a huge red flag, right? You're not going to be able to run the company unless you understand all the numbers on there. And so again, this is something you have to do yourself. All right, so to begin with, I'm going to run through some basic concepts that are really important to understand. And then we'll build a little spreadsheet together for a fictional startup. And I will get through all of that hopefully within 30 to 40 minutes. And then get to any questions. And then I will send you a follow-up email where I will send you the slides. I will send you the spreadsheet templates and some follow-up thoughts. Everybody good with that? All right, here we go. So financial statements are backwards looking documents, right? So we're not creating financial statements. So as I said, don't get all intimidated by accounting terms, because that's not what we're doing right now. The financial statements are backward looking documents for tax and reporting purposes, right? We got a brand new startup. We don't have any backward-looking financials to prepare for tax and reporting purposes right now. All we have is we're going to try to create a forward-looking model of what the basic economics of our venture are going to look like, right? So don't worry about all these accounting terms, because that's not what we're doing right now. At the end of your first year, you can hire a CPA to file your backward-looking financial statements. That's fine, but that's not what we're doing right now. What we're doing right now is creating an economic model for our startup. And all we care about for an early stage startup, all we care about is cash in, cash out, right? We don't care about depreciation tables and amortization. This is an early stage startup. It's just about how much money do we have coming in and how much money do we have going out. That's it. So we're building a cash on cash model. And the purpose of creating a good economic model for our startup is, first of all, to understand where the levers are, right? So for some startups, this particular number really matters a lot. For other startups, that number doesn't matter that much, but this number over here really matters a lot, right? And so identifying what the levers are for our particular venture is one of the goals of a good economic model. Informing the capital strategy, right? If we're going to have to raise some money, we need to know how much we need to raise, and we need to explain to investors what our use of that capital is. Uncover hidden insights, right? Everybody has assumptions going in about how the economics of your venture are going to work. But building the model, you may uncover some unexpected insights about how the economics of your venture are going to work. Understand scaling dynamics. So a services firm, for example, scales in a much different way in terms of the economics, scales in a much different way than a SaaS business does, a software as a service business. And so understanding our particular venture, what are the scaling dynamics for our venture? And then lastly, of course, communicating with investors and stakeholders that we're going to need a good economic model for those discussions. So to start with, I want you to understand three really basic, fundamental, important concepts: unit economics, enterprise economics, and customer economics. So here we go. Unit economics, customer economics, and in the middle there is enterprise economics. So unit economics is the concept that says that every venture distills down to the notion that there's one unit of something that we make, and we sell that unit for X, and it costs us Y, and X minus Y is our gross profit on one unit, right? Every venture of every kind distills down to this notion of unit economics. So, maybe we're a widget factory, we sell each widget for $1. Each widget costs us 25 cents to make, right? And so that is our unit economics for a widget factory. One widget is one unit for a widget factory. If we are a lemonade stand, then one unit is one glass of lemonade, right? If we're a consulting firm, then one unit is 1 hour of billable time. If we're a bakery, one unit is one average loaf of bread. For Netflix, one unit is one subscription month. And by the way, for any SaaS business, many of you probably have SaaS businesses, software as a service or some other subscription-based business. So one unit for a subscription business is one customer month, right? For an airlines talk about seat miles as their units. And so every venture distills down to this notion of unit economics. There's one unit of something that we make, we sell it for X, it costs us Y to produce, our gross profit on a unit is X minus Y, right? So think about, for your particular venture, what is one unit, right? I said if you're a SaaS business, then one unit is one customer month. If you're selling widgets, then a unit is one widget, right? Now, the concept of enterprise economics, the second concept I want you to understand, is that for every venture, every business of every kind, we have a certain amount of fixed overhead every month. All right, so we've got the management salaries, we've got insurance, we've got rent on the building, we've got utilities. That's our fixed overhead. Those, in the reason we call it fixed overhead, is that whether we're having a busy month or a slow month, those numbers are the same, right? The landlord expects us to pay the rent on the building, whether we sold 1,000 widgets this month or 5,000 widgets this month, our rent is the same. So we have this concept of fixed expenses, fixed overhead, right? And now we go out and sell units, right? And remember, on each unit, we make a certain amount of gross profit. So our gross profit is what we sold the unit for minus what that unit cost us to produce. That's the gross profit. And so we need to sell a certain number of units every month in order to break even, right? In order to cover the overhead. And then each unit that we sell over that is our operating profit, right? So again, these are very simple concepts, but it's really important that you have this in your head, that there's unit economics, which is this one unit of something we sell, and we make a certain amount of gross profit on each unit. And then there's the fixed expenses, the overhead. And so we need to sell a certain number of units every month in order to break even, in order to cover the overhead. And then units that we sell over that is operating profit. And then the last of the three concepts I want you to understand is the concept of customer economics, which is what does it cost us to get a customer? And then once we have a customer, how much money can we make from them? And so, and that is the engine of growth for our venture, right? Is that we spend a certain amount of money on getting customers. That's sales and marketing and advertising and that stuff, right? And if we take the money we spent in the month or in the quarter on sales and marketing and advertising, we divide it by the number of customers that we got during the quarter. Now we have what our average customer acquisition cost was, right? So if on average it cost us $10 to get a customer during the quarter, we better be able to make more than $10 from that customer, right? And so that's the concept of lifetime value against, customer acquisition cost against lifetime value of a customer. And that whatever it costs us to get a customer, we have to be able to make more than that from customers, right? It seems really self-evident, it seems obvious, and yet a leading cause of startup death is realizing too late that we have this equation upside down. So let's say we spent 10 grand in the quarter on sales and marketing and advertising, and in that quarter we got 1,000 new customers. Then pretty simple math tells us that our average customer acquisition cost during the quarter was $10. And now let's say we sell widgets, and let's say that we make a $5 gross profit on every widget we sell. And let's say that we have evidence that on average, once we have a new customer, they end up buying 2 widgets in their first order, and eventually they come back and buy 3 more. So the average new customer, once we have them, ends up buying a total of 5 widgets. Some more, some less, but that's the average. So if we make $5 on each widget, on average, a new customer buys 5 widgets from us, then our lifetime value of a new customer is $25. And so if we're spending $10 to get customers, we're making 25 from them. Winner, winner, chicken dinner. So this is customer economics. So, and here's a quick slide with just some of the some lifetime value numbers that I found out there. The average Netflix customer stays on board for 25 months. And so that's their lifetime value of a customer, 25-month subscription, $291. Again, some more, some less. That's the average. And Peter Drucker, the founder of management consulting, says that the purpose of a business is to create and keep a customer. And obviously what drives the lifetime value of a customer is the ability to keep them and keep them coming back and buying from you. In customer economics, for most startups, customer economics kind of trend like this. That at first the lifetime value of a new customer is relatively low because we don't have that much to sell them yet. And we don't have much brand loyalty yet or anything else. And so our lifetime value of a customer starts off low. And over time, our lifetime value of a customer goes up because we're getting better at keeping customers. We're able to cross-sell them and upsell them. We have new products coming out, etc. And so over time, the lifetime value of a customer should hopefully be going up. And also over time, the cost of getting a customer, our customer acquisition cost, is hopefully coming down because our sales and marketing and advertising is getting more optimized. We're getting some word of mouth referrals. We're getting some brand loyalty, right? And so over time, our cost of getting a new customer should be coming down. And then customer economics eventually reach that crossover point, right? And that is the point at which the operation is notionally cash flow positive, right? When we now have a sustainable way to get a new customer at a cost less than we can make from them, then boom, we have a notionally profitable company. So those are the three concepts I wanted you to get in your head: unit economics, enterprise economics, customer economics. Unit economics is, what is one unit for us? How much does it cost us to produce that unit? How much do we sell that unit for? And that then yields the gross profit on a unit. Enterprise economics says we have a certain amount of fixed expenses, that's our overhead, and therefore the math is pretty easy on how many units we need, because if we know the gross profit on a unit, then the math is pretty easy in terms of how many units do we have to sell each month or each quarter to cover the overhead, and then additional units put us into profitability. And customer economics, which is the notion that we're going to take $10 off the balance sheet, we're going to invest that $10 in sales and marketing and advertising, customer acquisition activities, and then what does that $10 come back to us as, right? That's customer economics. And we need to get to the point where we take $10 off the balance sheet, we invest it in customer acquisition activities, and it comes back to us as hopefully $30 or $40 or $50, right? That's customer economics. All right. Now let's build a spreadsheet. So a reminder, if you have any questions as we go along, just type them right there into the comment section, and I will do my best to deal with them on the fly, because great entrepreneurs have agility. Okay, so Eliar asks a really good question, which is a multi-product company and different subscription prices. So yes, and that's, of course, this is the reality for most companies. Ultimately, you want to do kind of a blended CAC, a blended LTV, a blended unit, right? And so let's say we sell small, medium, and large. And let's say that we think that 60% of our orders will be for the small version, 20% will be for the medium version, 20% will be for the large version. Once we kind of make guesses at that blending, that mix, then it's easy for us to come up with what is an average unit, right? So I think that's actually answered your question, Eliar, is first of all, keep it simple. And one way to simplify it is if you have multiple products, come up with a blended average and use that for your unit economics. Maria asks about depreciation, amortization, and interest. Maria, apparently you missed the beginning of this talk. Because at the beginning of the talk, I said that we're not going to worry about accounting terms. Accounting terms are for producing backward-looking financial statements. What happened last year, right? And what we're doing right now is for an early stage startup, all we care about is cash on cash, right? We are an early stage startup in our first year. All we care about is cash in and cash out. If it costs us $10,000 to buy a new machine, that machine costs us $10,000 out the door. That's all we got to care about. That's all we care about. At the end of the year, when our CPA prepares our financial statements, our CPA will probably say, well, that new machine you bought for $10,000, let's capitalize that on the balance sheet, and then we'll depreciate it every year. That's great. That's the accountant's job. But right now, for early stage startup, all we care about is cash on cash. And no problem. Yeah, I'm glad you brought it up because it's an important point to reiterate. Alex, yes, I will send you a recorded version later on. Okay, so let's build a spreadsheet, and let's build a spreadsheet for an awesome new startup called Taco Box. And let me tell you about the awesome new startup, Taco Box. So Taco Box is an amazing new startup where you buy a subscription, and every month we will send you a box with all of the ingredients to make an incredible taco feed for your friends and family. And it's all healthy, fresh ingredients. And each month we will feature a different region of Mexico with our Taco Box. And so that is the incredible new startup that we're going to quickly build a financial model for. So the first thing we're going to do is we're going to open up a spreadsheet program. It doesn't matter that much whether you're going to use Excel or Google Sheets or Airtable or any of the rest. Personally, I think Google Sheets is the way to go. Excel was the good way to go in 1995. It's not 1995 anymore. So I recommend Google Sheets because being able to share and collaborate with others matters a lot in today's world, but it doesn't really matter. Everything I'm going to show you could be done with any spreadsheet program. So the first important thing to do is to create different tabs. It's a lot easier to organize your spreadsheet if you create different tabs for the different different categories of expenses and income that you're going to put onto your economic model. I'm going to share with you at the very end of this call, I will share with you my template that I'm showing you here. And you can use that or you can just create your own, but either way, this idea of creating different tabs for the different categories will make it a lot easier for you. So the first tab is setup costs. These are the one-time non-recurring costs to get our startup off the ground, right? So we're going to hire a lawyer to do the incorporation. We're going to have to buy a couple laptops for our new startup. We're going to have to put a lease deposit on the new building. We're going to have to pay somebody to build the software, right? We're going to buy some furniture. So this tab is the one-time non-recurring setup costs for our startup. Now we're also going to have an assumptions tab. I like to put all of the assumptions on one tab because that makes it really easy to change and adjust those as we go along, right? So I've got here on my assumptions tab, all I have so far is the price for one taco box, $50. I have payroll load, meaning that anybody who we have on payroll, they cost us more than their salary, right? Because we also got to pay matching taxes, we got to pay benefits, we got to pay workman's comp, insurance, etc. If you put in 20 or 25%, that'll be safe. If you're going to be very generous with your benefits package, you can go a little higher than that. If you're going to be stingy with your benefits package, you can go a little lower than that. But again, I just have this on the assumptions tab because it's a whole lot easier to just have it in one place. And the same with the credit card fee, right? So I put in there 3% credit card fee for now. If we negotiate a special deal with Stripe where we get that down to 2.5%, then all we have to do is update it once on this assumptions tab and it'll flow through the entire model. So think about what things you have that are assumptions that you can put onto one tab so it'll be easier to maintain later. Our unit economics tab. So in this case, we have one taco box is 1 unit for us. So we sell it for $50. The cost of all the ingredients in there are whatever that says there, $27. And then we got the credit card processing fee, and that tells us what the gross profit is on 1 unit. So again, have a tab that has your unique economics on it. People are the most expensive thing for any company, right? By far, the people are your most expensive expense category. And generally speaking, you can break the people for your venture down into 2 categories. There's the people who are on the payroll as full-time employees, and then there are the freelancers and contractors. And so I have a different section here for each of those. The pink is the full-time employees who are on your payroll, and the blue is the freelancers. And then what I have here is kind of the idea of when they start. So you'll see there that I have some of these people starting right off the bat, and some of the people don't come into the picture until month 4 or month 5. I've got a freelancer doing marketing for the first few months, and then the freelancer ends because we're going to make a full-time hire of a marketing person. So kind of whatever that mix looks like for you. And then, of course, the people who are on your payroll, we need to add the payroll load to them, that extra cost for the taxes and insurance and such. The contractors, we don't have to add that for. And so the bottom couple lines there account for that and add up the total of what your people cost is. The marketing tab. So this is just like you think. This is all the ways in which we're going to spend money on sales and marketing and advertising for our startup. So we've got some Google ads, we've got some social media ads, maybe we've got an SEO agency, right? Whatever those things are. So put those there on the marketing tab. And as is true with all of these things, don't worry about getting these numbers right now. You're just going to punch in some numbers that are wild ass guesses. That's fine. The important thing is that we're building the model correctly. And if we built the model correctly, then updating and refining these numbers as we go along will be very easy. So don't get hung up right now thinking you need accurate prices, accurate costs. Just stick stuff in there. The general administrative tab. So this is the fixed expenses. So this is the rent on the building. This is the monthly utilities on the building. This is your monthly mobile service plan, your internet access plan, right? So all of the general and administrative fixed overhead expenses go onto this tab here. The revenue tab. So because Taco Box is a subscription business, and many of you probably have startups where your notion is it'll be subscription based. Here's how you want to model subscriptions, is that every month we get a certain number of new subscribers, right? Hopefully our sales and marketing is working really well, and every month we're getting some new subscribers. Also, every month we're getting some churn, meaning we're getting some existing subscribers who are canceling. So any subscription business pretty much looks exactly like that. It's how many new customers did we get during the period? How many new subscribers did we get during the period? How many old subscribers did we lose during the period, right? And then subscribers at the end of the last period, plus new subscribers, minus churn subscribers who canceled since the last one, equals our current subscriber number for the end of this period. So pretty simple math. And you're not going to know for sure what the churn rate is, right? You're not going to know for sure how many customers will cancel every month. But we can assume that that's a trend that will get better. We'll assume that early on our churn rate, people who cancel every month, will be high because we're still figuring this out. And then as we go along, hopefully our retention rate will be better, so our churn rate will be lower. So you can kind of just put that notion in there when you put in the churn number. Just put in the notion that it'll start off high and it'll come down over time because we're getting better and better at retaining customers and keeping customers. So that's the revenue tab. And in this case now, number of subscribers per month times our average subscription price, which in this case is the $50 on the Assumptions tab, equals the price, the gross revenue for the period. Now, this leads us to the third really important concept I talked about earlier, which is customer acquisition cost against lifetime value of a customer. So customer acquisition cost, very simple to calculate. It's how much money did we spend in the period on customer acquisition activities, that's sales, marketing, advertising, divided by the number of new customers that we got during the period, yields what our average customer acquisition cost is, right? So that's that top pink line, pretty simple math based on the numbers that we entered on the other tabs. Lifetime value of a customer, in the case of a subscription business, is just simply how many months do they stay with us as subscribers on average. So I mentioned before that for Netflix, it's 25 months. Netflix has some customers who are with them a lot longer than that. They have some customers who are with them a lot shorter than that. On average, the average Netflix subscriber is with them for 25 months. Again, this is a number that we will expect to see improve over time. And so we don't know for sure what that's going to be right now, but at least kind of let's put in there the notion that that's going to improve over time. And so then average number of months that a subscriber stays with us times our price per month for the subscription gives us the lifetime value of a customer. And then that yellow line there is the ratio of lifetime value of a customer over customer acquisition cost. So anything over 1 means that we're spending $10 on a customer and we're getting $10 or better back, right? And so the goal is to get it over 1, then we're in the money. Venture capitalists want to see that ratio be 4 or 5 or maybe even 6. Venture capitalists are greedy, so there's nothing wrong with having a business where it's getting maybe 3x. So for every $10 we take off the balance sheet, spend on sales and marketing, advertising, it eventually comes back as $30. That's a perfectly good business. Venture capitalists are going to want to see it a little bit more than that. And then, so if we take these numbers that are here and we graph them, what we'll see is kind of what we want to see, which is that Lifetime value of a customer starts off low and goes up. That's the red line. Customer acquisition cost, that's the blue line, starts off high and goes low. And again, so far, these are really just made up numbers. But if our made up numbers don't look something generally like this, then we have a problem, right? Because over time, our lifetime value of a customer kind of needs to be going up. Customer acquisition cost needs to be coming down. And so we need to kind of start off with a model and a set of numbers that says that if this all works out, these trend lines are what they need to be in order for this to be a profitable business. Okay. And then all of those tabs that I just showed you there roll up then here into the summary tab. And the summary tab is presented in exactly the standard way. So the standard way for an income statement is always the top line is the revenue. The next line is what our cost of that revenue was, cost of goods sold. And revenue minus cost of goods sold equals gross profit. And now we need to subtract out of that what our general, administrative, and sales expenses are, right? And so that's that next line. So we got the G&A, that's the fixed overhead. And then we have the sales and marketing under that. Gives us total SG&A. SG&A is sales, general, and administrative. The gross profit minus sales, general, and administrative equals net profit, operating profit. Okay. So this is the standard way of displaying this. And then you see I have there the one-time setup costs added in just in the first month, because those are one-time non-recurring costs. And then the bottom line there, what I have is, assuming our bank account had zero in it at the beginning, what is our running balance of our bank account? And so what you'll see is for the first few months there, looks like for the first 6 months, the running balance is negative, which is what you'd expect. And then after that, it begins to turn positive. And so now this gives us an idea of how much startup capital that we need. All right, so some questions. Yes, Jessica, I will fix that broken link. Thank you for telling me. And I will send, after this call, I will send out to you all as well. Eliar, how do you measure lifetime value for customers that are new or not having the knowledge? Right. So great question. And so the short answer to your question, Eliar, is we have no idea what a lifetime value is, right? Zero idea. But as you said at the end of your question here, a good way to do this is to try to find some other similar companies that you can benchmark to. So I mentioned Netflix, right? So if you were, if you're a streaming media company, or for a SaaS company, maybe you could look at Salesforce's numbers. So any public company, any publicly traded company, their financial statements are public, and so you can go look up exactly the numbers for any publicly traded company. And so I think you nailed the question. You nailed the answer to the question perfectly, Eliar, which is you don't know what your lifetime value of a customer numbers are going to be, but we can take a look out there and try to find some things to benchmark to, so that you don't embarrass yourself and go in front of an investor with numbers that are just way out of whack. If an investor says to you, "This looks really good. I'm curious how you came up with your LTV number." What you want to be able to do is say something like, "Well, that's a great question. Here's what I did. I went out and looked at these 3 companies that are kind of comparable to ours in terms of their business model, and I figured that would be a reasonable thing to use as a benchmark." So great question. Let's see. Right. So Shawnee asked a question about do you put the marketing costs in the month that the new customers were obtained, acquired, or in the following month? So the way I like to do this, because I think it gives you a more accurate look, is to put it in the same month. Even though we shelled out the money at the beginning of the month for our marketing activities, right? And it may be that a lot of those new customers actually end up coming to us in the following month, right? Because there's always a little lag time between when our spend for marketing is and when we see it in terms of new customers. So you could choose to offset it by a month if you wanted to, have the expenses in January and then divide that by the number of new customers in February. There'd be nothing wrong with doing that way. On this example spreadsheet, I have them in the same month. So if we spent $10,000 in the month, and in that same month we got 1,000 new customers, I'm assuming that means our customer acquisition cost was $10. So I think, Shawnee, you can do it either way. Just make sure that your logic is consistent through the model, and make sure if you were explaining it to somebody that you could explain it to them. And then Oliver, B2C, B2B, right. So Oliver, B2B and B2C are obviously slightly different businesses, but all three of these concepts that I talked about are exactly the same. We still have unit economics, we still have enterprise economics, we still have customer economics. As you say, Oliver, one of the differences with B2B is usually fewer customers. So just getting 3 new customers might be a huge win, right? Whereas consumer, often you need to get thousands of customers. Also longer sales cycles for sure, larger average sales price for sure, but it's still the same. The economics are still the same. And Oliver, here's an important point, is that with enterprise software, so B2B, kind of typical big B2B software sales, your sales cycles are long, and also you often have a direct sales force, right? And so you really need to look at, so if having a direct sales force is costing us, $30,000 a month, and on average, our sales team needs to go out and make, 6 sales calls over the course of 3 months to close a deal. That yields a high customer acquisition cost, right? Which is fine as long as when you close a deal, it has a high lifetime value. So if it cost us $30,000 to get a customer, when you add up what it's costing us to have a direct sales team and all the meetings they have to have, that seems like a lot, right? But if the average new customer deal that we sign is for $250,000, then the fact that it costs us $30,000 to get that deal, that's fine. That works out. And here's the last point I'm going to make, Oliver, on this, because I'm really glad that Oliver brought this up. I've had people say to me, my customer acquisition cost is 0 because I do all the sales myself. I go out, I meet with the clients, I do the follow-up meetings, I prepare the proposals. It often takes 2 or 3 months to get the deal done, but I do it all myself, and so my customer acquisition cost is 0. The flaw in that logic, of course, is that your customer acquisition cost is only 0 if you value your time at 0. So if you're doing all the sales yourself, that's awesome. That's great. But don't think that your time is free. And so if you sit down to try to figure out realistically what your customer acquisition cost is, put a reasonable, rational value on your time. And if it takes you 3 months and 6 meetings with the client to sign the deal, then put down a rational number for what the value of that time was. Maria asks about an AI-based business with token costs. Yes, so right. So let's think about this. Yes. So I think what Maria's asking is, let's say that we run an AI business, and so we have a big part of our cost of goods sold is what we're paying to the AI provider, Perplexity or Anthropic or OpenAI. So every month our customers paying us $10 a month for the subscription, and it's costing us an average of $3 a month in terms of the tokens we're paying for from our AI provider. So now, Maria, we're going to put that into our unit economics, right? So we charge $10 a month, and our cost of goods sold includes $3 a month that we are paying for the AI tokens. So put that in your cost of goods sold. which goes into your unit economics. And then also, Maria, to your very specific question, if we're giving away free trials, then those free trials are costing us something. And so if on average a person uses the free trial for 2 months, and on average only 15% of those convert to being paid customers, then you got to account for that money somewhere, right? And so you could put it in COGS, or you could actually, if you wanted to, you could put it into customer acquisition cost, because your free trial is kind of part of what you're spending on getting customers. So I think, Maria, the answer to your question is you could put it in either of those two places, but make sure it's accounted for. All right, guys, I'm trying to think of what I haven't covered. So here are the main takeaways for you. Don't get hung up on making these numbers perfect, because we don't know what these numbers are going to be, right? A lot of the things we've talked about, like, what's our customer retention going to be? How long is a customer going to stay with us? We don't know for sure. How much are we going to have to spend on marketing to get new customers? We don't know for sure. But don't get too hung up on that, because the beauty of spreadsheets is that you can just punch in numbers, and then they're really easy to refine and change later, right? So don't let that slow you down. Focus more on getting the model right, and we can adjust the individual numbers as we go along. Don't think you need to know all the fancy accounting terms. We're not doing amortization tables. We're not doing depreciation. We're not doing revenue recognition. All we're doing right now is creating an economic model that is simple cash in, cash out. Most of you know there are two ways to create a budget, right? You can create a budget top down or bottom up. So top down is when your boss says to you, you have $100,000 to spend in the quarter. Tell me how you want to spend it. That's a top-down budget, because you've already been told what the top number is. Now you're creating what the line items are in terms of how you want to spend it. A bottom-up budget is the boss says, how much do you need next quarter? And you sit down, you make a list of everything you need next quarter, bottom up, and then tell your boss what the top number needs to be, right? And so this is a bottom-up exercise. And lastly, and I cannot overemphasize this enough, that do not outsource this. Don't hire a freelancer. Don't have your friend who was once a CFO do it for you, because you got to feel these numbers in your bones. There's no way you're going to be able to run this company appropriately otherwise. And finally, get your head around these three fundamental concepts: unit economics, enterprise economics, and customer economics. Okay, Michael, if you start with one product, phase in additional products. Hopefully that won't affect the CAC too much. But yes, so your G&A may go up. I mean, maybe, Michael, maybe in month 5 you have some additional. You're adding an additional person to the head count because you now have more products that you're managing, right? That kind of thing. And also your unit economics may change, because our average sale price may be higher now because we have 6 different products, whereas when we started, we only had 1 product, right? So hopefully that's helpful, Michael. All right, guys, I said I was going to keep this to under 45 minutes, and it's been 44 minutes. So thank you so much for joining. I'm going to send you an email with slides and spreadsheet template and a variety of other things. Happy to answer questions. You'll find me as Brett Waters on all the socials, or just brettwaters@gmail if you want to send me an email. Thanks a bunch, and see you all soon. Bye.